Hello and welcome to this episode of Standard Deviation, my column and video series. Now, governments and regulators rarely have to face the problem of being too successful. Yet that is precisely the situation unfolding in India's banking sector, the stock market, and to do with the government's indirect tax revenues. Since 2014, the Narendra Modi government has been aggressively expanding access to banking services and also encouraging more people to participate in the stock market. Simultaneously, it has sought to substantially boost revenues from GST. The government and sector regulators have largely succeeded in all three of these areas, but success comes with its own difficulties. The most recent example of this involves the Ministry of Finance's unofficial decision to discontinue the monthly release of detailed GST revenue collection data. Although no formal announcement has been made, the release for June's revenue, which was due on 1st of July, was not put out. Ministry officials have unofficially said that while gross collection figures will be quietly disclosed, other details that were previously released will be withheld. ThePrint reported that this change in policy stems from concerns that high gross collection figures were fueling resentment amongst the public who felt that the government was collecting excessive taxes. Now, it must be said that the increase in gross GST revenue is primarily due to the administration's success in widening the tax net. GST rates have not been increased for years. In fact, the average rate of 11.6% is lower than pre-GST levels. The other point, as highlighted by former Chief Economic Advisor Arvind Subramanian, is that gross collection figures obscure the truth about GST. Once refunds are accounted for, the actual government revenue from GST has only now reached pre-GST levels as a percentage of GDP. So here's a case of the government turning squeamish about its own success and prioritizing optics over transparency. Rather than halting monthly releases, it should instead focus on conveying the reasons behind the rise in the gross numbers. It might even earn some praise from the public, although this is unlikely. Nobody likes to praise the government over taxes. But even if the praise doesn't come, the government should resume releasing the detailed data, given that it has a lot of broader policy implications, as noted by economists Pranab Sen and Surjit Bhalla in a recent conversation with ThePrint. Success, or the appearance of it, is not something to be scared of. The second success the government and its financial sector regulator, in this case SEBI, have been grappling with has to do with the retail participation in the stock market. Before COVID, the often heard refrain among stock market analysts as well as SEBI and government officials was that our market wasn't deep enough. Not enough people were participating. Since the pandemic, however, this has reversed. Now, the worry is that people might be participating too enthusiastically, particularly in the options market. As I had reported earlier, India accounts for nearly 90% of all options traded in the world. This was about 35% pre-pandemic. Several reasons account for this surge, but some have squarely to do with SEBI actively making it easier for people to trade in options. From reducing lot sizes to allowing an increase in the number of indices that are available for options trading, the last few years has seen SEBI and the exchanges doing a lot to fan the flame of the options trade in India. But now that flame might have grown too large. From SEBI chairperson Madhavi Puri Butch cautioning about the growth of the options market to the RBI highlighting its own concerns, the official line has reversed. Retail participation in the options market needs to be curbed. At least that's the new official line. Last week, SEBI asked exchanges and other market infrastructure institutions to implement a standard fee structure for brokerages and do away with the existing slab-based structure. What has been happening so far is that the exchanges take payment from the brokerages on a monthly basis based on a rate that is determined by the transaction volume of that brokerage. The brokerages then charge their customers on a daily basis, often at the highest slab. So the difference between what the brokerages pay the exchanges and what they earn from customers forms a significant proportion of the brokerage's revenue. With this change, however, that source of revenue will go, which some brokerages, including Zerodha, have said will mean that they might have to charge customers an even higher fee for futures and options trades. This could dissuade casual retail traders from participating in this segment. In fact, SEBI has also previously raised concerns about the massive participation of the public in the conventional stock market as well, particularly in small and mid-cap stocks. Here too, substantial success is being viewed as a bad thing. In the banking sector, the government has been touting the success of its JAM Trinity, comprising the Jan Dhan Yojana, Aadhaar, and mobile penetration, and rightfully so. The penetration of the banking sector was one of the core pillars of the government's relief efforts during the pandemic. But if you give people a bank account, they're soon going to move past the deposit aspect of banking and start taking advantage of the lending side. This is what's happening now. The growth of personal loans, which has been hovering within the 25 to 30% range, has comfortably outpaced the growth in lending in all other sectors since the pandemic. This growth has been driven by housing loans and unsecured loans. While the former are relatively safe, unsecured loans are by definition riskier since there's no underlying collateral to recover should these loans go bad. The growth in personal loans is a natural outcome of the increased penetration of banking services. The RBI has also been strengthening the NBFCs, which have in return amped up their lending to retail customers. But now the RBI is facing the flip side of its own success. Periodically through 2023, the central bank raised concerns about the growth in unsecured loans and asked banks and NBFCs to cut back on them. When this didn't work, it took direct action in November by making unsecured loans more expensive for lenders, which in turn made it more expensive for the borrowers. Simultaneously, some of the asset quality metrics of these loans have started to deteriorate. For example, the latest financial stability report has pointed out that for private banks, the share of slippages from retail loans, which is the fresh additions to non-performing assets or NPAs, is increasing. In other words, the government and the RBI encouraged people to sign up for bank accounts, but are now finding that they might be using banking services, particularly the lending function, too much for comfort. The government's reaction to its relative success with GST is just plain wrong and should be reversed. RBI and SEBI, however, need to take a more nuanced approach. While their concerns are undoubtedly valid, they should be careful they don't kill this growing enthusiasm for the financial sector amongst the public. These are the signs of a maturing economy, after all. But on that note, that's all from me. Thank you for watching.